In today's discourse, I'm delving into the intricate world of collapsing hedge funds, exploring the underlying reasons behind their downfall. Biotech Moose's infamous wall of shame has been witnessing a surge in hedge fund collapses lately, and the trend continues unabated. The recent casualty on the list is hedge fund Brevan Howard, making headlines by slashing 10% of its trading floor due to staggering losses. Macro Edge tweet highlights the severity of the situation, indicating that a single day of market downturn is wreaking havoc, forcing hedge funds to resort to drastic measures like layoffs. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. The root cause of these financial cataclysms can be traced back to the rampant leveraging practice by hedge funds. Leverage, essentially amplifying investment through borrowed capital, has become the norm rather than the exception. The average hedge fund is leveraging its funds by threefold, magnifying both potential gains and, more importantly, losses. When the market takes a downturn, these losses are exponentially multiplied, pushing hedge funds perilously close to the brink of collapse. Some hedge funds even go beyond the threefold leverage, indulging in risky maneuvers with 5, 7, or even 10-fold leveraging, essentially playing a high-stakes game where the margin for error is razor-thin. Take the case of George Weiss, whose hedge fund met its demise due to insurmountable losses. Despite seeking a buyer to salvage his sinking ship, Weiss found no takers, signaling the toxicity of his portfolio. Even though his reported losses seemed modest at 0.6%, the undisclosed liabilities and precarious positions spelled doom for his venture. This scenario underscores the hidden dangers lurking within hedge funds, where apparent stability can swiftly unravel into financial ruin. Moreover, the recent scrutiny surrounding hedge funds' clandestine communications adds another layer of suspicion. Attempts by prominent firms like Citadel to evade SEC investigation into their WhatsApp exchanges only raise eyebrows further. The reluctance to disclose conversations hints at a guilty conscience, reinforcing the notion that where there's smoke, there's fire. The fact that these entities are willing to engage in legal battles to safeguard their privacy speaks volumes about the potential skeletons lurking in their closets. The narrative extends to the broader implications of hedge funds' modus operandi. Their voracious appetite for leveraging and herd mentality in pursuing similar trades pose systemic risks to the financial ecosystem. Regulators, investors, and traders alike are growing wary of the domino effect triggered by mass exits from crowded positions. The profitability derived from such practices comes under scrutiny, raising questions about its ethical and legal underpinnings. In light of these developments, stakeholders are clamoring for tighter regulations to rein in hedge funds' unchecked exuberance. Proposed amendments to liquidity risk management frameworks reflect a proactive stance by regulatory bodies like the DTC. By contemplating measures to mitigate liquidity shortfalls during market turbulence, regulators aim to preempt a cascade of margin calls that could destabilize the entire market. However, critics argue that such leniency could embolden reckless behavior among hedge funds, exacerbating the underlying issues instead of resolving them. Meanwhile, voices advocating for genuine market resilience are gaining traction. CEOs like those of Palantir are championing sustainable growth over short-term profiteering, emphasizing the importance of nurturing robust businesses. Their stance against short sellers underscores the paradigm shift towards responsible investing, where long-term viability takes precedence over speculative gains. As the saga unfolds, one thing remains certain: the volatile landscape of hedge funds is fraught with peril. Whether it's the lure of leveraging or the opacity of communications, the underlying fragility of the system cannot be ignored. In navigating these turbulent waters, stakeholders must tread cautiously, lest they become casualties in the relentless pursuit of profit at any cost. The road ahead demands vigilance, transparency, and a steadfast commitment to safeguarding the integrity of the financial markets. Only then can we hope to avert future crises and usher in an era of stability and prosperity for all. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.